The British pound is coiling at 1.3495 like a spring, and the US PPI data is about to decide its fate. Here's the thing. With both central banks playing the same slow-cut game, this consolidation is the calm before the storm. I've mapped out the exact breakout levels and the two scalping setups that make sense right now. Catch the full breakdown on Trade Meridian Decoded. And I'll show you precisely where the stop losses are stacked. Let me cut through the noise immediately. The British pound is sitting at 1.3495, pinned between a stubborn double top at 1.3520 and a critical breakout floor at 1.3479. And today, the US Producer Price Index is the match that could ignite a move of at least 60 pips in either direction. But here's what most retail traders are missing. This isn't just about the headline print. This is about a policy divergence narrative that's quietly shifting beneath the surface, and I've been watching the bond spreads closely for the last 72 hours. I've seen this setup before, back in September 2023 when the market was equally complacent ahead of a CPI print that completely rewrote the short-term trajectory. The compression we are seeing across the technical indicators, with the ADX sitting at a paltry 13.5, tells me we are looking at a coiled spring that's about to release with significant force. The question isn't whether pound sterling to US dollar moves, it's which direction traps the maximum number of traders before reversing. This is your 30-second window to get positioned correctly. I'm going to walk you through exactly what the data is showing, where the institutional flows are concentrated, and why I believe the contrarian setup is the one that offers the most compelling risk-reward profile. My immediate bias on pound sterling to US dollar heading into the New York session is neutral to bearish, with a strong bias toward a short squeeze if we break north of 1.3520. The critical invalidation level for any bearish thesis sits at 1.3525. A clean break and close above that level on a 4H candle would force me to completely reassess the structural outlook. But here's where it gets interesting. The weekly chart still shows a bullish structural high-low sequence dating back to the 1.3400 area, and I've been noting that each pullback has found bids at progressively higher levels. The monthly trend remains firmly bullish, supported by that long-term ascending channel that's been in place since early 2024, yet the daily and 4H pictures tell a different story. We've got price action pinned beneath a cluster of short-term moving averages, the MA5 at 1.3498, MA10 at 1.3504, MA20 at 1.3508, and MA50 at 1.3512 are all stacked directly overhead like a technical ceiling. That's 4 resistance levels compressed into a 14-pip range, and the fact that price has been unable to penetrate the cluster tells me sellers are actively defending the 1.3516 to 1.3520 zone. The RSI at 41.30 confirms sellers have the near-term edge, though we are not yet in oversold territory on the daily time frame. The MACD has printed a bearish crossover with the signal line, and the histogram is showing expanding red bars, classic continuation signals for short-term downside. What stands out to me is not just the technical configuration, but the way the market has responded to the UK GDP data. That 0.4% print was exactly in line with expectations, and the fact that sterling failed to rally on the news tells me buyers are exhausted at these levels. So here's my verdict. We are range-bound until the PPI data drops, with the 4H pivot at 1.3502 acting as the intraday control line. Below that, and especially below 1.3479, the path of least resistance is lower toward 1.3440 and eventually 1.3400. Above 1.3520, and we could see a violent squeeze toward 1.3547 and potentially 1.3580. Let me paint you the complete picture starting from the higher timeframes and working our way down, because this is where the real institutional money is positioning. On the weekly chart, pound sterling to US dollar has been challenging that major structural barrier near 1.3520 for the better part of a month. This is a level that's rejected price on 3 separate occasions since the NFP report, and each rejection has been met with aggressive selling. The weekly candle bodies are getting smaller, momentum is waning, and the Bollinger Bands are starting to contract, all classic signs of a market that's building energy for a directional move. But here's what gives me pause. The weekly RSI is sitting at 52, completely neutral, and the MACD on this timeframe is still holding above the signal line. So the weekly picture is more of a pause than a reversal, and that's an important distinction. Moving down to the daily chart, we've got a flat consolidation that's been contained inside a 20 pip range for the better part of 4 sessions. The daily candlestick patterns have been alternating between indecision dojis and tight-botted candles, and the ATR has dropped to 0.0068, which is exceptionally compressed for this pair. I've seen ATR compression like this maybe 4 times in the last 2 years, and in 3 of those instances, it was followed by an expansion move of at least double the average range. That suggests to me that the next move could be anywhere from 140 to 200 pips if we get a catalyst on the 4H timeframe. The ADX reading of 13.5 confirms what the price action is screaming: there's no trend here. We are stuck in a horizontal channel with well-defined boundaries, and the pivot point at 1.3502 is acting as a perfect fulcrum. Price has spent the better part of the Asian and early London sessions oscillating around this level, and the fact that we've broken marginally below it suggests sellers are starting to gain some traction. The 1H chart shows price slipping progressively lower beneath the volume-weighted average price lines, and this is where I see the immediate tactical setup. We've got a bearish flag forming on the 1H chart with the pole being the decline from 1.3520 down to 1.3480 earlier in the week. The flag itself is a tight consolidation, and if we break below the flag's lower boundary near 1.3475, the measured move target's 1.3440. Now let me connect the fundamental dots, because this is where the real money is going to be made or lost today. The UK preliminary Q2 GDP report came in at 0.4% quarter-over-quarter, exactly matching consensus expectations. This confirms structural resilience in the British economy, but it also removed any potential surprise catalyst for sterling bulls. When an economic release prints exactly as expected in a range-bound market, the typical reaction is to fade the non-reaction, meaning traders look to sell the news and push price back toward the bottom of the range. But the main event is still ahead of us. At 8:30 a.m. Eastern Time, we are getting the US Producer Price Index for July, both month-over-month and year-over-year, alongside initial jobless claims. This is a dual-barrel data drop, and the combined impact could be substantial. Here's what I'm watching. The PPI is a leading indicator for consumer inflation, and with energy prices showing stickiness at elevated levels, there's a real risk of a hotter-than-expected print. If we see core PPI coming in above the 0.2% monthly consensus, the dollar is going to rally aggressively. Why? Because it reinforces the narrative that the Federal Reserve cannot cut rates as quickly as the market had been pricing just 3 weeks ago. The Fed speakers scheduled for later today, Barkin and Hammack, will only reinforce this hawkish repricing. Conversely, if PPI comes in soft, say 0.1% or lower, that opens the door for a dovish repricing and a potential short squeeze in pound sterling to US dollar. The market is already positioned net short on sterling, as evidenced by the retail sentiment data showing bearish positioning predominance. From a contrarian perspective, this is the fuel for a sharp, vertical squeeze. There's also the geopolitical overlay to consider. Safe haven dollar flows have been accumulating steadily amid heightened tensions near global energy choke points. I'm not going to speculate on specific geopolitical outcomes, but I am watching how the dollar reacts to headline risk, and right now, the greenback is benefiting from this backdrop. Let me be specific about the fundamental catalyst that matters most. The yield differential between US 10-year Treasuries and UK gilts has been widening slightly in favor of the dollar over the last week. This is where the smart money is looking, not at the headline CPI or GDP numbers, but at the bond market's reaction to those numbers. If we see the 10-year Treasury yield spike on the PPI print, that's the confirmation signal for dollar strength. The convergence between the Fed and BOE on the rate cut timeline is a key driver here. Both central banks are pushing back against market expectations for aggressive easing, and when you have two major central banks singing from the same hymn sheet, currency pairs tend to remain range-bound unless there's a significant data divergence. Today's PPI print could be that divergence. Let me give you the 3 setups I'm watching for the next 24 hours. And I want to be crystal clear about the triggers and the invalidation levels. Scalping setup 1, Short fade to resistance. This is my preferred intraday play heading into the New York session. With the 4H moving averages stacked between 1.3498 and 1.3512, I'm looking to fade any corrective pullback that pushes price back up into the 1.3505 to 1.3512 structural pocket. The trigger is a rejection candle on the 5-minute or 15-minute time frame, ideally with a bearish divergence on the RSI or a bearish MACD crossover on the lower time frame. The entry would be confirmed at 1.3505, with my first take profit at the immediate structural support at 1.3480, and I'd scale runners out near 1.3465. My stop loss gets placed tightly above the moving average cluster at 1.3525, and this gives me a risk-reward ratio of approximately 1.5 to 1 on the first target and 2.5 to 1 on the extended target. The invalidation is simple. If we see a 5-minute candle close above 1.3525, I'm out of this setup completely. But here's where my experience tells me to be careful. I've seen this exact divergence pattern play out in November 2024 when the market was equally compressed ahead of a major data release, and the squeeze caught a lot of short sellers off guard. The tell was the break above that 1.3525 level. Once the shorts started covering, the move accelerated rapidly. So if we break that level, I'm not shorting anymore. I'm actually considering the long side, scalping setup too. Long on sweep support. If we get a false breakdown, I'm looking to buy the dip. The key level here is 1.3479, which represents the critical horizontal breakout structural floor. If price sweeps below this level and quickly recovers, especially if it coincides with a bullish divergence on the 1H stochastic indicator, I'd be looking to enter long. The entry would be at 1.3475 with the stop loss at 1.3440. Giving me a tight 35 pip risk. The first take profit target would be the 4H pivot at 1.3502, with runners extended toward the range resistance at 1.3516. This setup offers a better than 1-to-1 risk-reward ratio on the first target and nearly 2-to-1 on the extended target. What I'm really watching for here is the interaction with the 1.3440 ascending channel support. If we see price make a deeper sweep down to that area and hold, that would be a much higher conviction entry. But remember, I'm trading this based on the immediate data reaction. The first 5 to 10 minutes after the PPI print are usually the most chaotic and the most profitable if you can read the initial reaction correctly. Swing trading setup, breakout or breakdown. The swing trade is about the structural breakout from this range, and I have two scenarios mapped out. Scenario 1 is the bullish breakout. If we get a soft PPI print that triggers a rally above 1.3520, I'm looking for a clean 4H candle close above 1.3520 to confirm the breakout. The entry would be on a retest of that level as support, with a stop loss at 1.3479 and a first take profit target at 1.3547, with runners extended to 1.3580 and potentially 1.3643. This setup offers a risk-reward ratio of approximately 1.5 to 1 on the first target and better than 2 to 1 on the extended target. Scenario 2 is the breakdown. If we get a hot PPI print, I'm talking 0.3% or higher month over month, and we see a clean break below 1.3475 on a 4H candle, I'm looking to short the breakdown. The entry would be at 1.3470 with a stop loss at 1.3535. And the first take profit target would be 1.3400, with runners extended to 1.3360. This is the higher probability setup given the current technical configuration, and the risk reward is exceptional. I want to take 60 seconds and talk about risk management, because this is where I see traders consistently making mistakes, especially around high-impact data releases. The ATR on pound sterling to US dollar is currently at 0.0068. Which tells me the average daily range is compressed. When we get a volatility expansion off the PPI print, that range could easily double or triple in the first hour. That means your stops need to be wide enough to accommodate normal market noise but tight enough to protect your capital if the trade goes against you. For the scalping setups, I'm risking no more than 1% of my account on each trade. The short setup risks 30 pips, and I'm sizing accordingly. For the swing trade, because it's a breakout play, I might risk up to 2% because the risk-reward is more favorable. Let me share a personal experience that shaped how I trade data events. Back in February 2024, I was positioned short on pound sterling to US dollar ahead of a UK CPI print that came in unexpectedly hot. My stop loss was too tight, and I got stopped out for a 60 pip loss before the market continued lower by over 200 pips. That taught me to widen my stops around data releases, and to position size appropriately for the volatility. I now always add a 20% buffer to my standard stop-loss calculation around high-impact news events. The other critical point is to avoid chasing the initial move. The first 5 minutes after a data release are often characterized by wild swings, liquidity sweeps, and stop hunting. I prefer to wait for the initial flush, see the reaction at key technical levels, and enter on the second or third wave of the move. This approach has saved me from countless fakeouts over the years, so let me summarize where we stand on pound sterling to US dollar going into the US PPI data. The pair is compressed in a tight range between 1.3479 and 1.3520, and today's data is the catalyst that will likely determine the next significant move. My bias leans bearish below 1.3502. But I'm acutely aware of the short squeeze potential if we break above 1.3520. The critical levels to watch are the 4H pivot at 1.3502, the double top at 1.3516 to 1.3520, and the structural support at 1.3479. I'm positioned with 2 scalping setups and a swing trade mapped out, and I'm watching the bond yields for confirmation of the dollar direction. The PPI print is the main event. But don't overlook the jobless claims data and the Fed speakers later today. Here's what I want you to do. Drop your bias in the comments below. Are you long or short pound sterling to US dollar heading into the PPI print? And what's your key level? I'll be monitoring the comments throughout the session and I'll highlight the best analysis. If you found this breakdown helpful, make sure to subscribe and hit that notification bell. I'm going live with a full reaction recap in my weekend preview covering all major pairs. And I'll be breaking down exactly how today's data reshapes the central bank outlook. Remember, the market is about to give us a directional clue. The compression we are seeing is the proverbial calm before the storm. And when the storm breaks, we'll be ready. Trade smart, manage your risk, and I'll see you in the next video.